In order to begin to understand how our financial system works, we need to go back to the early 1900s, 1910 to be exact. Everyone at some point in their lives has heard of the Federal Reserve, but most likely don't understand what it is or how it works. The Federal Reserve, referred to as the Fed, is a central bank that many economists refer to as the biggest robbery ever enacted on the American people. The reason for this is because the Federal Reserve is neither part of the federal government nor does it have any reserves. Yet, this single organization controls the money supply of the most powerful country in the world. The Fed is very diligent in hiding the fact that they are not part of the government. The last thing they want the American people to fully understand is that our government does not control our own money. In order to achieve this, they were very clever and decided to call their institution the Federal Reserve. And by labeling themselves this way, the general public never thought twice about who was in control of the country's money supply. If the Federal Reserve is not part of the government, then who controls this private organization and how did this come to be? The answer to this question is what changed the course of our country forever. In November of 1910, a secret meeting took place of 6 bankers and economic policymakers who represented the financial elite of the Western world. It was hosted at the J.P. Morgan estate on Jekyll Island in Georgia. In attendance was Senator Nelson W. Aldrich, Abram Piatt Andrew Jr., Assistant Secretary of the Treasury, Frank Vanderlip, President of National City Bank of New York, Henry P. Davidson, Senior Partner of J.P. Morgan and Company, Charles D. Norton, President of First National Bank of New York, Paul Warburg, Director of Wells Fargo, Benjamin Strong, the emissary for J.P. Morgan and, coincidentally, the first president of the Federal Reserve. Years later, Frank Vanderlip referred to this meeting as the actual conception of what eventually became the Federal Reserve System. This meeting was so secret at the time that not even the names of those who attended were mentioned to the servants who lived and worked on the island. The men who attended came on a late-night train, claiming to be on their way to a hunting expedition, but instead, these bankers met with Senator Nelson Aldrich to draft what would eventually become the Federal Reserve Act. This private meeting, attended by some of the most powerful men in America, was strategically designed to take control of our country's money supply and to achieve ultimate power in America. Mayer Amschad Rothschild, one of the most powerful European bankers of his time, stated it best when he said, "Permit me to issue and control the money of the nation, and I care not who makes its laws." On December 23, 1913, 2 days before Christmas, when most people in Congress were home with their families, the Federal Reserve Act was signed into law by President Woodrow Wilson. That single act, however small it may seem, transferred the control of our monetary system from our government into the hands of some of the wealthiest men in our country. Putting into law the Federal Reserve Act gave unlimited power to a few wealthy banking institutions in America. The Fed has the power to issue currency, manipulate interest rates, and run secret bailouts. Yet Congress and the President are not allowed full oversight over this powerful organization. The Federal Reserve enjoys a monopoly over the creation of our nation's money and credit, but for 100 years, they have never been completely transparent and accountable about it. And we don't have to look back too far from today to see what it looks like in real life. When testifying before Congress in 2009, Fed Chairman Ben Bernanke refused to disclose which institutions received trillions of dollars in these bailouts and loans, or give our representatives details about what deals were being made.
So my question to you is, will you tell the American people to whom you lent $2.2 trillion of their dollars? Will you tell us who got that money and what the terms are of those agreements?
Hundreds and hundreds of banks, any bank or that has access to the U.S. Federal Reserve's discount.
Will you tell us who they are?
No.
In an interview with Treasury Secretary Timothy Geithner, he makes the stunning assertion that conducting a full audit of the Federal Reserve, something never before done in its 100-year history, is a line that we don't want to cross. to be denied full transparency of these transactions after U.S. taxpayers contributed over $16 trillion to these bailouts and loans is unthinkable and unconstitutional. It is our right as American citizens to know where our money is being spent. It's very ironic that if you don't give the IRS full transparency with your finances, you go to jail. But if you're a private organization of elite bankers that controls the money supply of a country, you're free to do as you please without full oversight. This private organization is arrogant in the fact that the same accounting laws that apply to the rest of America do not apply to them.
There is no other agency of government which can overrule actions that we take.
Their control appears to be unlimited, and 2008 is the most recent example of how much power the Fed actually has on our country.
Many of us were told in private conversations that if we voted against this bill on Monday, that the sky would fall, the market would drop 2,000 or 3,000 points the first day, another couple thousand the second day, and a few members were even told that there would be martial law in America if we voted no. That's what I call fear-mongering.
The elite banking institutions took trillions of dollars worth of risk, and when they lost their bets, they threatened politicians to use taxpayer money to bail them out, or else we would face an Armageddon type of scenario. This historic change of power in America is again why many economists refer to it as the biggest robbery ever enacted on the American people.
The Federal Reserve System virtually controls the nation's monetary system. Yet it is accountable to no one. It has no budget, it is subject to no audit, and no congressional committee knows of or can truly supervise its operations. These are the words of the late Professor Murray N. Rothbard, economist and academic vice president of the Ludwig von Mises Institute. The Institute is dedicated to the ideals of a free market and sound money. This program is dedicated to the memory of Murray N. Rothbard and his prolific work on money and banking. For more than 20 years, the living standards of middle-class Americans have steadily declined. Incomes have remained flat or fallen, and the opportunities and security we once took for granted have begun to fade. For most families, one income no longer pays the bills. It requires two or more incomes to afford a home, pay medical and child care expenses, and put children through school. Unless present trends change, young workers are unlikely to ever live as well as their parents. Good jobs with a future are harder to come by. Education doesn't count for what it once did. Taxes continue to rise, while Social Security is going bankrupt. Private pensions are no longer reliable. Economic volatility and uncertainty are on the rise. Politicians espouse numerous theories about the cause of this country's economic woes. Seldom, however, do these officials look below the surface. The roots of our economic ills can be traced to central banking and our present monetary system. The Federal Reserve claims to manage our money. Instead, it makes our money worth less and less every day. It has generated continuous and worsening business cycles and lowered our living standards.
It's really no different from a burglar in your house wanting to steal your money. That's what the Federal Reserve does. It depreciates your savings, it takes away your economic security, and it ought to be treated as an institution that does that rather than something of alleged benefit.
Money is supposed to serve as a reliable standard of economic value, not a source of instability. Until we restore sound money and take away the government's ability to debase it, we have little hope of restoring the freedom and prosperity that made America great.
And we really have a choice of what we want in money. Do we want money that's going to be losing its value every year, or do we want money that's going to be gaining in value? If you are happy with your money losing value, then you want the present system. If you want money to increase in value, then you want a gold standard.
What is money? As the good that makes exchange possible, it's the foundation of every economic activity. In the earliest times, people traded goods and services directly. This form of exchange is known as barter.
That is, if a fishing tribe desired to have maybe wheat, which they themselves did not produce, they would seek out other individuals that produced wheat, and then they would exchange their fish.
But barter had limitations in the marketplace.
Well, actually, people perceived pretty quickly problems with that direct exchange. If you wanted, for example, fish, and you had wheat, but the people who had fish didn't desire the wheat, you were stuck, okay? Unless you went out and found some other good, possibly berries, that everyone in that society consumed. Then you would trade your wheat for the berries in full confidence then that you could turn around and trade the berries for the fish or anything else that you desired.
Eventually, the most widely accepted goods in a society became valued for their use in indirect exchange. Money is simply another name for the most generally accepted medium of exchange. Throughout history, many goods have served as money. Feathers from the Quetzal bird were used for exchange by the Mayan Indians up to the 15th century in Central America. Tea leaves compressed into bricks were traded in East Asia through the 1800s. Wampum shells were money to North American Indians, while early American colonists traded beaver pelts, which had a high value both at home and abroad. Metal coins first emerged in Greece and Asia Minor during the 7th century BC. Gold and silver were valued for their use and beauty in jewelry and the decorative arts. They were durable, easily divisible, and limited in supply. These precious metals also had a high value-to-weight ratio, making them easily transportable.
You might think back, or we can think back to a time when iron was used as money, for example, in Africa. But imagine going into Sears Roebuck and trying to purchase, let's say, a lawnmower for $350. That would take a ton of iron, whereas it would only take an ounce of gold.
In 1536, less than 50 years after Christopher Columbus set foot on American soil, a Spanish mint in Mexico City struck the first coins made in the New World. These silver coins eventually found their way into the British colonies. Great Britain's mercantilist policies deliberately tried to keep precious metals out of America, so the Spanish milled dollar became the unofficial currency. It was often divided into 8 pieces for smaller transactions, hence the term pieces of 8, with 1/4 of the coin being 2 bits. In 1792, Thomas Jefferson adopted the dollar as this country's official monetary unit.
He looked around, he investigated to see what were the American people using as money, and that was the dollar. And so that's why that dollar became the standard of the United States. And we went onto a gold and silver standard and started minting gold coins with the American Eagle, the $10 gold coin.
Jefferson, in particular, spoke eloquently of the dangers of paper money. During the War for Independence, the Continental Congress printed vast sums of paper money out of thin air to finance the Army. The diluted money supply naturally depreciated to almost nothing, leading to the phrase, "not worth a Continental."
And the people who held on to these notes, who tended to be patriotic Americans, concerned about, wanted America to be free of British control, lost everything. Whereas the Tories, who wanted nothing to do with this American government money and immediately got rid of it, were benefited. And Peloton Webster, the first American economist, and others who looked at this saw that this paper money, unbacked by gold, was extremely dangerous.
As early as the 16th century in Europe, goldsmiths stored gold coins for their customers for a fee and issued receipts for the gold to the depositor. Thus began the use of paper as money.
In other words, if you came in and deposited 10 ounces of gold for safekeeping, you got back receipts in the amount of 10 gold ounces. Okay? And those receipts entitled you to instantaneously redeem that gold.
These receipts soon became widely accepted as a means of exchange, since it was easier and safer to use the receipts for significant transactions. This was the origin of banknotes as money substitutes. These first bankers then took this process one step further.
In effect, if the goldsmith had 1,000 ounces of gold and 1,000 ounces of legitimate receipts being held by the depositor of that gold, he could increase his profits by merely printing up another 1,000 ounces worth of receipts and lending them out. Okay? In which case you would effectively get 50% reserve banking or fractional reserve banking. Only a fraction, 50% of the receipts were now backed by gold.
There was no longer a one-to-one ratio of paper to gold. Now there could be 3 or 4 pieces of paper in circulation for every unit of gold in the vault. These bankers were no longer simply storing or warehousing gold for a fee. They were artificially inflating the money supply and loaning out these phony receipts at interest. This system became known as fractional reserve banking and was later transported to the early American colonies. It formed the root of American commercial banking and ultimately the Federal Reserve System.
This is a fraudulent system. It's not allowed in any other business. If you had a grain warehouse that had loaned out the grain it was supposed to have in storage, that's considered criminal. The guy would go to jail. But the banks are the one industry that's allowed to get away with this and to profit from it.
Alexander Hamilton became the first Treasury Secretary and in 1791 set up the first Bank of the United States as America's central bank to expand the supply of paper money for the benefit of the government and the commercial banks.
Alexander Hamilton believed in a strong central government, and he saw a central bank as one of the means by which the government could be centralized and by which its power could be expressed.
Thomas Jefferson opposed this view. He saw a central bank as an undemocratic tool of the northeastern banking establishment. It was dismantled after 20 years.
Jefferson was an opponent of a strong central government and at all costs wanted to remove the central bank.
In 1816, the federal government made another attempt to set up an inflationary central bank. But this second Bank of the United States was denounced by President Andrew Jackson as a monster bank for benefiting a few at the expense of many.
They inflated the money supply, which brought about a boom initially, that is prosperity to the country, followed by a bust. When they stopped inflating the money supply, many businesses that had depended on the low interest rates that were introduced or induced by the initial inflation went out of business.
Jackson succeeded in abolishing the second central bank in 1836. But by then, speculators had set up hundreds of new private banks with little or no gold to back the notes they issued. The nation's monetary system became more stable when the United States introduced a gold standard in 1834. The dollar was worth approximately 1/20th of an ounce of gold.
The gold standard was understood by the Founding Fathers, by Andrew Jackson and others, as being a money of the people. That is, it was a hard money, a money that could not be tampered with, that could not be inflated to permit government expenditures skyrocketing.
But by 1862, Abraham Lincoln needed to fund his invasion of the South. So once again, the government began to print up paper money.
Basically, the United States went off the gold standard in order to finance the Civil War. Okay, and you'll find in history that almost every large war, every major war, has involved a departure from the gold standard, because the gold standard puts strict limits on government financing.
Lincoln's notes became known as greenbacks because they were printed in green ink rather than the usual black ink on the reverse side. These so-called fiat notes were deemed legal tender by the government, but they were not redeemable in gold.
Lincoln, under cover of war, issued tremendous numbers of greenbacks. Gold was still circulating, but people were forced to accept these greenbacks as if they were at par with gold.
The government's power to print unbacked paper notes would later become the pillar of the Federal Reserve System. After the Civil War, the nation's monetary system became sounder when the U.S. adopted a gold standard.
We went back on the gold standard in 1879 and had probably the greatest period of growth and of prosperity ever in the country's history.
For nearly 20 years, the total output of goods and services grew at an unprecedented rate of 4% per year.
The reason being that with a sound money and without the ability to manipulate the interest rate, we had a lot of genuine saving and investment, which then led to more capital goods and higher labor productivity in the United States.
In the midst of this prosperity, the big industrialists and financiers were plotting to expand their empires with the help of government. With the passage of the Interstate Commerce Act of 1887, the large railroads succeeded in blocking their smaller competitors through regulation.
The ICC was put in place in order to protect the railroad owners from competition. Okay? It was not the case that it was going to protect consumers or shippers. In fact, consumers were hurt because ultimately, with higher railroad rates, they were forced to pay higher prices for the goods and services that were shipped across the country.
By 1896, they were poised to do the same thing with the banks. Two camps emerged as leaders in this economic war. They were led by J.P. Morgan, the world's most powerful private banker, and John D. Rockefeller, the oil tycoon. Morgan and Rockefeller were great adversaries, but despite their business differences, they both favored a central bank. They wanted cheap credit and an inflated money supply to finance the expansion of their empires. Together, they led the campaign to sell the idea to the American public, which later led to the founding of the Federal Reserve.
If the American people got wind of the fact that this bank was not in their interests, okay, if in fact they understood that it was in the interests of the financial elites who would use it to inflate the money supply and in doing so increase their own revenues, they would have been held to pay. The legislation would have never passed under those conditions. So it had to be sold to the American people as a way of making their currency more elastic.
The bank reform campaign received a boost in 1907 when there was a run on some of New York's biggest banks thanks to their fractional reserves. Panic spread among depositors who got wind of the bank's insolvency and tried to withdraw their money. The Knickerbocker Trust failed, and two other institutions went to the brink of bankruptcy despite a $35 million bailout from J.P. Morgan. Wall Street swiftly adopted the fear of bank failures to sell the idea of a central bank, or lender of last resort, to the American public.
And so the Federal Reserve was to be the lender of last resort. In case any bank got into trouble, they wouldn't have to worry. They'd get the cash from Washington, D.C.
The question is, however, whether it is really desirable to have such a thing as a lender of last resort. The correct position appears to me that every single bank should be responsible for its own debts and contractual obligations. And if banks, through imprudent policy, then go bankrupt, this should not be considered a bad thing, but in fact considered to be a magnificent thing, because bankruptcies, the danger of bankruptcies is precisely what makes banks adhere to sound policies.
Bank runs and failures continued at an alarming rate. In 1908, the National Monetary Commission, headed by John D. Rockefeller Jr.'s father-in-law, Senator Nelson Aldrich, was set up to push for a central bank. In November of 1910, under the guise of a duck hunting trip, 6 men took a secret train ride to an exclusive private club on Jekyll Island, Georgia, to write a central banking act. The classified gathering read like a who's who of American banking. There were 2 Rockefeller men, Aldrich and Frank Vanderlip of the National City Bank of New York, 2 Morgan men, Henry P. Davidson from Morgan Bank and Charles D. Norton, president of Morgan's First National Bank of New York, Paul Warburg, a Kuhn Loeb partner, and Assistant Treasury Secretary A. Piatt Andrew, who was friendly to both camps. They spent a week at the luxurious club as Morgan's guests, crafting the proposals that would form the basis of the Federal Reserve System. It would be 3 years before their vision was realized. Just before Christmas 1913, the Federal Reserve Act was passed by Congress and signed by President Wilson. It established a Federal Reserve System to oversee monetary policy and regulate the commercial banks.
It's no coincidence that the Federal Reserve System was established by the Wilson administration. This was the height of the Progressive era, a time of tremendous government expansion and of special interest deals in Washington.
There are 12 regional reserve banks concentrated in the East and the Midwest. The Board of Governors of the Federal Reserve controls and coordinates their activities. The board is made up of 7 members appointed by the President. Even though there were 12 regional banks, Wall Street soon ran the show. As president of the New York Fed, Morgan protege Benjamin Strong seized control of the board's Open Market Committee operations. Strong would remain the dominant force at the Fed until his death in 1928. The Federal Open Market Committee, now based in Washington, directs the Fed's most important instrument of monetary policy, the purchase and sale of government securities on the open market. To increase the supply of money and credit, that is, to inflate, the Fed buys government securities from a few hand-picked firms with newly created money. To tighten money and credit, the Fed sells securities. In this, it can act on its own discretion.
Every government wants the ability to create new money. Okay? It's an alternative to raising taxes. Taxes, as we said, when they're raised, tend to evoke a lot of resistance among the public. It's much less painless to increase the money supply. The effects, the negative effects, don't occur until 6 months, a year, 2 years later, at which time the increasing prices can be blamed on other factors, the weather, speculators, and so on.
Another device the Fed uses to control the amount of money in circulation is setting the discount rate. This is the interest rate charged to member banks when they borrow short-term from the so-called discount window. If the Fed lowers the discount rate for its loans, commercial banks will likely borrow more from the Fed. This increases the amount of funds banks have to lend. Bank credit thus becomes cheaper, as reflected in lower interest rates on bank loans and credit cards. The increase in funds available for banks to lend also increases the amount of money in the economy. The Fed can also manipulate the nation's money supply by raising or lowering the reserve requirement. Banks are required to set aside a percentage of their deposits as reserves to meet depositors' demands. When the Fed was established in 1913, it cut reserve requirements in half over the next 4 years, doubling the money supply by the end of World War I. But the Fed's real power lies in its monopoly to create money. Although the U.S. was still on the gold standard in 1913, it was quickly eroded as the Fed continued to expand the money supply. The first step was backing Federal Reserve notes by only 40% in gold, allowing the money supply to be increased 2.5 times. The inflationary effect of fractional reserve banking was also heightened by the central bank.
The commercial banks are permitted to create checkbook money on top of Federal Reserve notes. That is to say, the commercial banks are only obliged by law to hold reserves in the form of Federal Reserve notes of 10% to back all demand deposits that they have. 90% of their demand deposits are backed by nothing.
The Federal Reserve System adds another inflationary layer to an already unstable banking system. For example, if the central bank has $100 worth of gold reserves in its vaults and a 10% reserve requirement, it can print up $1,000 of new notes and deposits, which become the reserves of the commercial banks. The commercial banks take this $1,000, and if they're required to hold 10% again in reserve, they can multiply the $1,000 into $10,000 through fractional reserve loans. So an inverted pyramid is created with $100 worth of gold or real money at the bottom and $10,000 of inflated paper money at the top. As this $10,000 in new paper money circulates in the economy, it drives prices up, therefore reducing the buying power of ordinary citizens.
When they spend that money, the people who get the new money first and are able to buy products with it benefit, and the people who get it at the end lose, because when they go to spend it, prices have already gone up, and so they're able to buy less. And so there's a transfer of wealth and of power from some segments of the economy to others because of the actions of the central bank. And basically those who benefit are the government itself, big banks, and government contractors, and anybody who's closely associated with the federal government.
By making enormous amounts of credit easily available, the Fed can also drive down interest rates, sending out the wrong signal to investors. It sets in motion an unsustainable investment boom that carries with it the seeds of its own destruction. It's this business cycle that is ultimately responsible for economic disasters such as the Great Depression. Soon after the Federal Reserve was established, the U.S. entered World War I. Once again, the government temporarily abandoned the gold standard to print more money to finance the war effort. The U.S. government borrowed heavily, and the national debt ballooned from $1 billion to $27 billion. A sharp spike of inflation followed. This set off a cycle of rapid expansion and contraction in the economy. To dampen the overheated economy, the Fed halted its inflation, causing interest rates to nearly double over the next 18 months. By 1921, the market began to recover. New technology helped to increase productivity. Markets developed for new cars and appliances. The 1920s were a period of extraordinary growth. But behind the scenes, much of this growth was distorted by a Fed-generated inflationary credit expansion.
This was the Roaring 20s. This was a period of increasing affluence. That hid the inflation from American economists.
The Fed-generated bubble burst in the Wall Street crash of October 1929. Speculators who had borrowed money to buy shares when bank credit was readily available saw the stock market lose 1/3 of its value. Bank loans totaling $7 billion were outstanding. As the speculators defaulted on their loans, bank failures spiraled, and the Great Depression set in.
Depositors lost their bank accounts, both their savings deposits and checking deposits. They saw them disappear into thin air.
In 1932, Franklin D. Roosevelt was elected president and quickly implemented a New Deal policy of spending us to prosperity. Even though we needed lower taxes and lower spending, his administration would seek unprecedented amounts of money to finance its big government programs. In his inaugural speech on March 4, 1933, Roosevelt vowed to put an end to poverty and the unemployment lines and get people back to work. It didn't work. The Depression got worse, thanks to increased central planning. FDR only succeeded in making the monetary system even less sound. Just after taking office, the president declared a 4-day nationwide bank holiday, absolving the bankrupt fractional reserve banks of any need to repay their depositors. But before the banks reopened, the Roosevelt administration had to come up with a scheme that would lead people to believe that new deposits would be safe. It created the Federal Deposit Insurance Corporation to lull the public into a sense of security. In reality, the Federal Deposit Insurance Corporation holds just 0.5% of all the deposits it insures. But what people are counting on is that the Fed, as the lender of last resort, would step in and print whatever money would be necessary to prevent a massive bank run. By the mid-1930s, control of the Fed by the New York bankers was drawing to a close. The Morgan era ended when President Roosevelt, who was no friend of the Morgans, appointed Mariner Eccles as its governor. Eccles, a Republican from Utah, moved the activities of the Open Market Committee to Washington. President Roosevelt was on hand for the dedication of a new $3.5 million building to house the Fed.
I dedicate this building today to progress toward the ideal of an America in which every worker will be able to provide his family at all times with an ever-rising standard of American comfort.
1933 also marked the beginning of the end for the gold standard. There was no end to Roosevelt's appetite for spending on such New Deal programs as the gigantic $13 billion Tennessee Valley Authority, which flooded vast areas of productive farmland to provide government-subsidized electricity. The Works Progress Administration, which spent $11 billion on make-work jobs and pork barrel public works. But the U.S. currency was tied to gold, which limited the amount of money the Fed could print to pay for these costly projects. So the government scrapped the gold standard for American citizens in 1933, and then Roosevelt confiscated the people's gold. As in World War I, the warring parties in the Second World War abandoned the gold standard to finance the war with central bank-generated inflation. After the war, there was an attempt to use the prestige of the gold standard to establish a global inflationary system. The world's financial leaders met at Bretton Woods in New Hampshire under the direction of the famous economist John Maynard Keynes. Their idea was to set up a new international monetary system that would have both gold and inflation.
Under this system, the U.S. dollar would be redeemable in gold, but only for foreign official institutions, central banks and foreign governments, at the rate of $35 per ounce. All other currencies would have fixed exchange rates with the U.S. dollar, and they would be redeemable in U.S. dollars.
The New York Times editorialist Henry Hazlitt was one of the first to realize that this semi-gold standard would not succeed.
Even from the very beginning, it was doomed to failure, and this very outstanding journalist at that time, Henry Hazlitt, predicted it wouldn't work, because he says the temptation will always be that the government will print more money because they will accept these dollars and they won't demand the gold and won't hold the government in check. And he was absolutely right.
During the 1960s, the U.S. government was trying to meet the cost of massive social welfare programs at home and the Vietnam War abroad. By printing more money, President Lyndon Johnson believed, the U.S. government could accomplish its goals without raising taxes, which may have caused a taxpayer revolt. In other words, it could have both guns and butter.
We will make sure that every dollar is spent with the thrift and with the common sense which recognizes how hard the taxpayer worked in order to earn it.
But the more money the U.S. printed, the more it eroded the value of the dollar. Nervous foreigners began redeeming their dollars in gold, as they were entitled to do under the Bretton Woods Agreement. After paying out billions in gold, the U.S. was left with $36 billion worth of outstanding debt to foreign creditors and gold reserves worth just $18 billion. Rather than stop the inflation, in 1971, President Richard Nixon refused to redeem any more dollars.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
It was the death knell for the Bretton Woods semi-gold standard and a triumph for the Federal Reserve. The dollar would no longer have even the illusion of a fixed value against other currencies. It would float against them, causing even more dislocation in foreign trade and massive uncertainties for businessmen. Worse, the final check on dollar creation disappeared, creating endless possibilities for inflation. It's running at more than 300% since 1971, thanks to the Fed's power to create money out of thin air and to insured deposits. No U.S. federal budget has been balanced since it abandoned the gold standard.
I don't think that that's something that enhances the efficiency of our economy. I believe that the best money is a market-determined money, okay, such as we had under the gold standard. In order to get back to a market-determined money, the Fed has to be abolished.
There is not now, nor has there ever been, any direct control over the Fed by the President or Congress. The meetings of the Federal Reserve Board are held in secret, and nobody knows exactly what goes on. If you watch the business report every night, commentators are constantly speculating about what the Fed might do.
All eyes were on Washington today as the Federal Reserve met to decide the future direction of interest rates.
Most economists expect the Fed to leave monetary policy unchanged.
It has spawned a whole industry of Fed watchers who try to second-guess the Fed.
Federal Reserve has been surrounded by secrecy ever since its planning, its installation, and its operations to the present day. And the reason is because they can't tell the truth. If they told the truth, there'd be a revolution and there'd be a bunch of Americans, they're ready to all toss them out of the building.
A recent attempt to open the Fed to public scrutiny came in 1993. The head of the House Banking Committee, Representative Henry Gonzalez of Texas, called for an independent audit of the Fed's operations. He wanted the proceedings of the Open Market Committee videotaped, with detailed minutes released within a week instead of vague summaries issued several weeks later. Gonzalez also proposed that the president choose the 12 heads of the Fed's regional banks instead of powerful bankers. Predictably, Fed Chairman Alan Greenspan resisted the changes. What was surprising was President Bill Clinton's position. He declared the reforms would, quote, run the risk of undermining market confidence in the Fed. After the Mexican government inflated and devalued the peso in 1995, the Mexican economy went into a tailspin. Alan Greenspan lobbied Congress and the Clinton administration for a $52 billion bailout. As it turned out, the Fed's member banks held as much as $26 billion in Mexican debt. With no choice in the matter, American taxpayers and savers paid the bill.
The congressmen themselves, from my experience they're pretty naive, and they don't understand that the few that have to, like the chairman of the banking committee, is aware of this and goes along with it, and they continue to perpetuate this myth that the Federal Reserve brings about stability and they do good things for economic growth, even though they're the culprits. They're the ones who have caused all the problems. They're the ones who caused the recession, the unemployment, and the downsizing of business and all the ill effects that we have to witness. But their PR job is excellent because they have convinced most congressmen that they are very necessary to maintain stability and economic growth and all these wonderful things that they claim credit for.
It is clear that the United States cannot rely on Alan Greenspan or any other Fed chairman to fight the chronic inflation that has wrecked our savings, distorted our economy, redistributed income and wealth, and brought us devastating booms and busts. Despite the established view, Greenspan, the Fed, and big commercial bankers are not the inflation fighters they pretend to be. The Fed and its allied banks are not part of the solution to inflation in the business cycle. They are the problem itself. To limit chronic inflation and boom-bust business cycles, the currency must be backed 100% by gold. That would remove the Fed's ability to print money, which amounts to no more than legalized counterfeiting. Instead, there would be a monetary system where gold serves to anchor the dollar, rather than the fiat reserves created by the Fed.
If we were to establish a real gold standard, the average American family would benefit tremendously. First of all, there'd be more jobs, better jobs, more secure jobs, more business opportunities, no more business cycle, no more recessions and depressions. People's savings would be secure. You wouldn't have to worry if you put away money for your old age that its value would be stolen by the central bank and by the central government as they are today.
Under a 100% gold standard, there would be no place for fractional reserve banking. For checking accounts and other demand deposits, the banks would keep reserves on hand to meet depositors' claims. Banks would receive a fee from their customers for keeping their gold. In loan banking, investors would hand over their money for a fixed period of time to earn interest. Once the gold standard is in place, individual bank depositors would always have access to their money, and investors would be kept informed of their balance sheet. And at a national level, a tight rein would be kept on government spending.
You have relatively price stability. You have a stable purchasing power for the money. You eliminate the business cycle. You have reasonable interest rates rather than gyrating interest rates, and you get rid of the political manipulation of interest rates and the political manipulation of the money supply. And this then preserves wealth and builds wealth and allows for economic growth.
It's as simple as this. Sound money means economic prosperity and limited government. Unsound money means inflation, recessions, and depressions, and big government. What sort of system do we want for our families? Don't we want prosperity and security that we can hand on to future generations? Transition to a gold standard will not be easy, but as Murray Rothbard put it, the alternative is much worse. Since 1980, the Fed has enjoyed the absolute power to do literally anything it wants. To buy not only U.S. government securities, but any asset whatever. To buy as many assets and to inflate credit as much as it pleases. There are no restraints on the Federal Reserve. The Fed is master of all it controls.
You are about to learn one of the biggest secrets in the history of the world. It's a secret that has huge effects for everyone who lives on this planet. Most people can feel deep down that something isn't quite right with the world economy, but few know what it is. Gone are the days where a family can survive on just one paycheck. Every day it seems things are more and more out of control, yet only 1 in a million understand why. You are about to discover the system that is ultimately responsible for most of the inequality in our world today. The powers that be do not want you to know about this, as this system is what has kept them at the top of the financial food chain for the last 100 years. Learning this will change your life because it'll change the choices that you make. If enough people learn it, it'll change the world because it'll change the system. For this is the biggest hidden secret of money. Never in human history have so many been plundered by so few, and it's all accomplished through this, the biggest scam in the history of mankind.
They say that money doesn't grow on trees, but the truth is that the modern banking system creates currency far faster than trees can grow. Most people don't have a clue how currency is created. Economists and bankers make it sound so complex that people think they can't understand it. But I'm going to strip our monetary system down to its essence so that you can see the scam behind the curtain and just how it affects you. Every modern society creates currency in pretty much the same way. But since the US dollar is the majority of the world's currency, I'm going to use the United States as our example. It all starts when some politician says, "Vote for me and I'll make sure the government provides you more free stuff than my opponent will." But there's no such thing as a free lunch. So to provide that supposedly free stuff, the politicians vote for the country to spend more than its income. This is called deficit spending. To pay for that deficit spending, the Treasury borrows currency by issuing a bond. So what's a bond? If you think about it, a bond is really nothing but a glorified IOU. It's a pretty piece of paper with numbers printed on it that says, "Loan me $1 trillion today, and I promise over a 10-year period I'm going to pay you back that $1 trillion plus interest." But what you need to understand is that Treasury bonds are our national debt. These glorified IOUs are to be paid back by you and I and our descendants through future taxation. Therefore, when the government issues a bond, it steals prosperity out of the future so that it can spend it today. The Treasury then holds a bond auction, and the world's largest banks show up and compete to buy part of our national debt and make a profit on it by earning interest. You'll notice that as we move through this process, the big banks are there, taking a cut every step of the way. This isn't by chance, as you'll see shortly. Then, through a shell game called open market operations, the banks get to sell some of those bonds to the Federal Reserve at a profit. To pay for the bonds, the Federal Reserve opens up its big old checkbook and writes bad, bogus, counterfeit checks that should bounce because they're drawn on an account that always has a zero balance. There isn't one penny in there. To quote from the Boston Federal Reserve, "When you or I write a check, there must be sufficient funds in our account to cover that check. But when the Federal Reserve writes a check, there is no bank deposit on which that check is drawn. When the Federal Reserve writes a check, it is creating money." The Fed then hands those checks to the banks, and at this point, currency springs into existence. The banks then take that currency and buy more bonds at the next Treasury auction. But what is a check? A check is also an IOU. When you write a check, you're making a note that says, "Here's my IOU for cash. All you have to do is go to the bank and pick it up." Now, it's very, very important that you understand this process because we're going to come back later and show you the devastating effect this has on you. The Treasury issues IOUs, bonds. The banks then buy those IOUs with currency. The Federal Reserve then writes IOUs, checks, and hands them to the banks in exchange for the Treasury's IOUs, the bonds. And currency is created. So what's really happening is the Federal Reserve and the Treasury are just swapping IOUs, using the banks as middlemen, and abracadabra, presto, currency magically springs into existence. This process repeats and repeats over and over again, enriching the banks and indebting the public by raising the national debt. The end result is that there's a buildup of bonds at the Federal Reserve and currency at the Treasury. This process is also where all paper currency comes from. The Federal Reserve and the government mistakenly call it base money because they didn't watch episode 1 of this series and they don't know the difference between money and currency. But I will correctly refer to it as base currency because it is not money. It is currency, and as we've learned, there is a big difference. Money has to be a store of value and maintain its purchasing power over long periods of time. We learned in episode 1 that earlier in our history, our paper currency was just a claim check. It was a representation for real money of intrinsic value, the gold and silver that was held on deposit at the Treasury. You could walk into any bank and slap your currency, like say a $20 bill, on the counter and redeem it for real money, a $20 gold piece. But now, this base currency that's piling up back here is really nothing but a receipt or a claim check on an IOU, that bond. So it's really nothing but a supply of numbers. The Treasury then deposits the newly created currency into the various branches of the government, and the politicians say, "Hey, thanks for that." And the government does some deficit spending on public works, social programs, and war. The government employees, contractors, and soldiers then deposit their pay in the banks. Now, this may come as a shock to you, but when you deposit your currency with the bank, you're not actually depositing it into an account to be safely held in trust for you. Instead, you're actually loaning the bank your currency, and within certain legal limits, they can do with it pretty much anything they please. This includes gambling in the stock market and loaning it out, at a profit, of course. Now this is where the machine of currency creation really gets cranking, because this is where something called fractional reserve lending comes into play. Fractional reserve lending is exactly what it says. The banks are allowed to reserve only a fraction of your deposit and loan the rest out. Although reserve ratios may vary, I'm going to use a 10% reserve ratio as our example. If you deposit $100 in your account, the bank can legally take $90 of it and loan it out without telling you. The bank must hold $10 of your deposit in reserve just in case you want some of it. These reserves are called vault cash. But why does your bank account still say you have $100 if the bank has stolen $90 of it? Because the bank left IOUs it created, called bank credit, in its place. Now I know this sounds crazy, but here it is in black and white from the Fed. Commercial banks create checkbook money when they grant a loan simply by adding new deposit dollars in accounts on their books in exchange for a borrower's IOU. These are nothing but numbers that the banks type into their computers. And even though these bank credit IOU numbers are very different from base currency numbers, because they only exist in computers, they are still currency. So now there is $190 in existence. Now the reason people take out loans from the banks is to buy something. They're going to buy a house or a car or something like that. So the borrower takes the $90 that the bank loaned to him from your account and he pays the seller of the item. But then the seller deposits that currency into his account and his bank loans out 90% of that and leaves bank credit numbers in its place. So now there's $271 in existence. This process repeats and repeats until under a 10% reserve ratio, an initial deposit of just $100 can create up to $1,000 of bank credit, all backed by $100 of vault cash, just 10%. But as I said, reserve ratios vary wildly. On some deposits, it's 10%, on others, it's 3%, and on some forms of deposits, reserve requirements are 0. The result is that the expansion of the currency supply by the banks is far greater than even this example would lead you to believe. So once again, when currency is deposited in the banks get to lend it out, and then it gets redeposited and relent, redeposited and relent, redeposited and relent over and over again, creating bank credit all the way. This is where the vast majority of our currency supply comes from. In fact, 92 to 96% of all currency in existence is created not by the government, but here in the banking system. Now, massive amounts of currency spewing into society may at first sound like a fun idea. That is, until you remember one of the most important hidden secrets of money from episode 1, that the prices of everyday goods and services act as a sponge on an expanding currency supply. The more currency we have, the more prices rise. This is where inflation comes from. The true definition of inflation is an expansion of the currency supply. Rising prices are merely the symptom. So our entire currency supply is nothing but a couple of bucks whipped up in this hocus-pocus scam where the Treasury and the Federal Reserve swap glorified IOUs, and a bunch of numbers that the banks just type into their computers. That's it. That's our entire currency supply. It's nothing but a supply of numbers. Some of them printed, most of them typed, and there is nothing else. But if you thought that was crazy, get ready to enter the twilight zone of modern economics. We work for some of that currency supply. True wealth is your time, but we trade away moments of our lives, hour by hour, day by day, and year by year, for numbers that somebody printed on pieces of paper or just typed into a computer. Now those numbers represent our blood, sweat, tears, labor, ideas, and talent. We are what gives the currency its value. But here comes the really cruel joke. We work hard so that we can save some of that currency, so that we can pay the tax collector. In the United States, it's known as the IRS. They then turn it over to the Treasury so that the Treasury can pay the principal plus interest on that bond that the Federal Reserve bought with a check drawn on an account that has nothing in it. Now let's do a recap on this section, because this is where the system begins to rob you and I on a massive scale. Much of our taxes are not used for schools, roads, and public services, but to pay interest on bonds that the Federal Reserve bought with a check drawn on an account that has nothing in it. The Federal Reserve is committing fraud. But here's one of the biggest secrets of them all.
Before the establishment of the Federal Reserve, there was no need for personal income tax. The Federal Reserve was created in 1913, and that very same year, the Constitution was amended to allow income tax. Do you really think this was just a coincidence? Ask yourself how much income tax you've paid over your lifetime. Much of it has been silently siphoned away into the hands of those who own the system. Yes, this system has owners. Who they are is an even bigger secret that we'll get to shortly. But first, we need to understand the mumbo-jumbo of the so-called debt ceiling. It's all based on a huge paradox. There was interest due on that bond, and there was interest due on every one of those loans that the banks made. That means that there is interest due on every dollar in existence. Let me ask you something. If you borrow the very first dollar into existence, and that's the only dollar that exists on the planet, but you promise to pay it back plus another dollar's worth of interest, where do you get the second dollar to pay the interest? The answer is that you have to borrow that one into existence and promise to pay it back with interest as well. So now there are $2 in existence, but you owe $4, and so on and so on. The result is there's never enough currency to pay the debt. There is always more debt in the system than there is currency in existence to pay the debt. Therefore, the whole system is impossible. It is finite. It will come to an end one day. What would happen if the government stopped borrowing to do deficit spending? Are the payments on those treasury bonds going to stop? What would happen if the public stopped borrowing and going deeper into debt? Are your house and car payments going to stop? No. There is a payment due every month on the principal plus the interest on every dollar in existence, and those payments do not stop. If we stop borrowing, then no new currency is created to replace the currency that we used to make those payments. Whether you're making a payment on a loan or paying tax to make a payment on a bond, the portion of the payment that goes to pay off the principal extinguishes that portion of the debt. But the debt also extinguishes the currency. Currency and debt are like matter and antimatter. When they meet, they annihilate each other. If we just pay off the principal only on all the loans and bonds that exist, the entire currency supply just vanishes. So if we don't go deeper into debt every year, look what happens. The whole thing goes into a deflationary collapse under the weight of those payments. Politicians and pundits alike talk about balancing the budget, paying down the debt, and living within our means. They don't understand that that is deflationary. It is impossible to do under our current monetary system without collapsing the whole economy. This is why any talk of a debt ceiling is not only ridiculous, it's delusional. The system is designed to require ever-increasing levels of debt just to continue. And that's why politicians will always kick the can down the road and raise this so-called debt ceiling over and over again until the whole system finally collapses under its own weight. In other words, they don't want it to collapse on their watch. The Founding Fathers of the United States knew the dangers of central banking and fought to free themselves from this very thing. The Revolutionary War started out as a tax revolt, but now we must pay tax just to have a monetary system. Having just suffered through the hyperinflation of the continental dollar, which was printed into oblivion to finance the Revolutionary War, they understood the dangers of fiat currency and debt-based monetary systems. So to protect future generations from institutional theft and out-of-control government, they wrote into the Constitution that only gold and silver can be money for the simple fact that you can't print them. Our current system is not only unconstitutional, but it robs us of the liberty and prosperity our forefathers fought and died for. We are all feeling the effects of ignoring the Constitution right now. By forcing more currency into circulation, our purchasing power is diluted. Inflation is a slow and insidious stealth tax that is simply the result of this debt-based monetary system. This system empowers and benefits those who create the currency and receive it first, as they get to spend it into circulation before it has an effect on the economy. They're stealing purchasing power from you and transferring it to the banks and the government every hour of every day because of this false monetary system.
And it's not like the people at the top don't know this. To quote the Federal Reserve, the decrease in purchasing power incurred by the holders of money due to inflation imparts gains to the issuers of money. This is a fraud. It is a pyramid scheme, it is a Ponzi scheme, it's a scam, and it's a lie. Our entire monetary system is nothing but a form of legalized theft. But here's the biggest con job of them all. The Federal Reserve is not federal, it has stockholders. There is no federal agency that has stockholders. What's a stockholder? A share of stock represents a percentage of ownership in a corporation. So the stockholders are the owners of that corporation. Therefore, the Federal Reserve is a private corporation with owners. And you can see it for yourself if you go to the Federal Reserve's website, and it will say, the stockholders receive an annual dividend of 6%. Now we know that the stock in the Federal Reserve was originally issued to the largest banks in the United States. But because of mergers and acquisitions through the years, you can't actually trace who owns the stock in the Federal Reserve. That's a very closely guarded secret. My guess would be that the owners are those primary dealers, the banks that get to make a profit by selling part of our national debt, those bonds, to the Federal Reserve, who buys them with a check from nothing. Then we pay tax to pay the principal and the interest on those bonds so that the Federal Reserve can pay the banks a 6% dividend. Don't be alarmed if you don't quite comprehend the deception of this system at first glance. Very few people do. It is purposely complex. The economist John Maynard Keynes once wrote, "By this means, government may secretly and unobserved confiscate the wealth of the people, and not one man in a million will detect the theft." I believe that presented correctly, anyone can understand this system, regardless of how complex it is. So let's do a recap and break it down even more. The way the system works is that, step 1, the government creates glorified IOUs. These bonds increase our national debt and put the public on the hook to pay it back. Step 2, IOUs are swapped to create currency. The Treasury sells the bonds to the banks. The banks then turn around and sell our national debt at a profit to the Federal Reserve, which they probably own. The Federal Reserve then opens its checkbook that doesn't have a penny in it and buys those IOUs with IOUs that it writes, checks, on a checking account that has a zero balance. Then they give those checks to the banks and currency just springs into existence, and then the whole process repeats. This results in a buildup of bonds at the Federal Reserve and currency at the Treasury, which is really just a supply of numbers. The Treasury then deposits the numbers in the various branches of the government, and we get to step 3. The government spends the numbers on promises, public works, social programs, and war. Then the government employees, contractors, and soldiers deposit their pay into the banks, and we get to step 4, where the banks multiply the numbers by magically inventing more IOUs through fractional reserve lending, where they steal a portion of everyone's deposit and lend it out. That currency gets redeposited, and then a portion is stolen again, and the process repeats over and over, magnifying the currency supply exponentially. Then we work for some of those numbers, which brings us to step 5, where our numbers are taxed. We pay tax to the IRS, who then turns our numbers over to the Treasury, so the Treasury can pay the principal plus the interest on bonds that were purchased by the Federal Reserve with a check from nothing. Then we get to step 6, the debt ceiling delusion. The system is designed to require ever-increasing levels of debt and will eventually collapse under its own weight because politicians always kick the can down the road. They don't want it to collapse on their watch. And finally, step 7, the secret owners take their cut. The world's largest banks own the Federal Reserve. Those banks make a profit selling our national debt to the Fed. They make a profit when the Fed pays them interest on the reserves held at the Fed, and the Fed pays them a 6% dividend on their ownership of the Fed. This system is fundamentally evil. It funnels wealth from the working population to the government and the banking sector. It is the cause of the artificial booms and busts of modern economies, and it causes great disparity of wealth between the rich and the working class. And it is only possible because we no longer use real money, we use currency. But worst of all, It is a form of enslavement. Bond is the root word of bondage. Whenever a government issues a bond, it is a promise to make us pay tax in the future. Nobody asked you if you wanted to pay tax today for the prosperity we all enjoyed in the last century. Nobody is asking our children if they want to work hard in the future to pay for the prosperity we're enjoying now. George Washington once wrote to James Madison, "No generation has the right to contract debts greater than can be paid off during the course of its own existence." By stealing prosperity from tomorrow so we can spend it today, we enslave ourselves and future generations. Now this all sounds pretty bad, but there is great hope, for you are the greatest threat to this false monetary system. This system relies on the public being ignorant of its workings. Please share this knowledge with everyone you know, because an informed public that fully understands the system can build a better future for generations to come. And now I leave you with this quote, widely attributed to a former director of the Bank of England. The modern banking system manufactures money out of nothing. The process is perhaps the most astounding piece of sleight of hand that was ever invented. Banking was conceived in inequity and born in sin. Bankers own the earth. Take it away from them, but leave them the power to create money and control credit, and with the flick of a pen, they will create enough money to buy it back again. But if you want to continue as the slaves of bankers and pay the cost of your own slavery, let them continue to create money and to control credit. This is the Federal Reserve in Washington, D.C. It's located on Constitution Street, and that is just as much of a joke as the New York Fed being located on Liberty Street. Both of them are unconstitutional, both of them limit our liberty, and they transfer wealth away from us every second of every day to the Federal Reserve, to the government, and to the banking sector. You are now among the 1 in a million who can detect the theft of your prosperity. So the big question is, what can you do about it? 1. Watch this video until you can describe and teach it to others. Those who understand this system can make preparations for its unavoidable collapse and protect themselves. History shows that those who don't will probably be wiped out. 2. Share this video with everyone, especially those you care about. All it takes is a mouse click or two to get this message in front of millions. Post this video on Facebook, tweet it, email it to loved ones. Please share it wherever you can. 3. Join the conversation. The current world monetary system is based on a 300-year-old design meant to enrich a few at the expense of the many. There must be a better way. At hiddensecretsofmoney.com, we've created an open-source platform for the design and development of a new world monetary system. We're calling on every economist, every student, every college, every bright mind, and anyone who cares to join the discussion. In educating ourselves and each other, we can prevent the further loss of our freedoms and maybe, just maybe, win some of them back.
I think your episode 4 is very beneficial, very helpful. It's going to introduce these ideas to a lot of people, and like I've just been talking about, we have to change people's mind, and the more they understand it, the better. And I think we're at this point now where more people in the last several years, 4 or 5 years, have thought about the Fed than they ever have in the previous 95 years. So I think an explanation and diagrams to show it is very helpful, because quite frankly, they're not going to get it in their grade school. They're not going to get it in their high schools. They're not going to get it in college unless they're in a very rare circumstance to understand how this works.
You know, for years before I got involved in really studying gold and some of the things I write and talk about today. I was a monetary economist for decades. You know, in your video, you talk about the primary dealers. I was chief counsel and chief credit officer, one of the largest primary dealers for 10 years. So I had an inside seat on the Treasury market and have the privilege of working with several former vice chairmen of the Board of Governors, Manley Johnson and David Mullins, going back to the 80s and 90s. So I'm very immersed in what you were talking about. And I thought it was extremely accurate, extremely clear. I didn't think you were stretching on any points. It was really like something out of a PhD course, except that it was very easy to understand. I think it's accessible. I think we're seeing a little bit of a revolution in communications in the following sense. You know, as you point out, the Fed was created in 1913. Well, in 1913, there was no web, there was no YouTube, no Twitter. There was really no one to kind of stand up and oppose the Fed or call them out, if you will, or really get into a discussion that everyday Americans could follow. That's not true now with social media and everything else. You can reach out to millions and tens of millions of people and tell them what's going on. I think you've done that. You've done it successfully. I applaud it. I think this is a great video. I look forward to seeing it again. I know millions of people will enjoy it.
Well, as we know, the Federal Reserve believes it can create money out of thin air, not realize money is supposed to represent real products and services. And what people don't realize is when the Fed does that, in effect, as Keynes pointed out, it's a form of taxation. It's a form of confiscation. And because people don't see it, the politicos get away with it, but it also undermines social trust. It just is corrosive throughout society. We're going to have a lot of turmoil in the coming years, but it's going to be the kind of turmoil that leads to positive things. So don't despair. Get out there and fight, because the tide is going to turn. This is going to be the status last stand.
Thank you.
This episode of Mike Maloney's Hidden Secrets of Money was brought to you by GoldSilver.com and the new Silver Pegasus Round. To learn how to protect your family and turn the coming economic storms into opportunity, visit GoldSilver.com.